I think the thing that we've been excited about the economy for all year. We've seen strong fiscal policy supporting the economy. We've seen monetary policy supporting the economy. We've seen financial conditions, the stock market, wealth supporting the economy, and we've seen optimism about the future related to AI-driven growth supporting the economy. The thing that's been tweaked in our spreadsheet the most has been inflation, and that's coming out of the war. It's coming out of what's going on with energy prices. And it's really that combined with the Fed getting more optimistic about the labor market has made us rethink how long the Fed is going to stay on hold. We've had the Fed on hold basically until the Earth deorbits into the sun 5 billion years from now. We've had them very firmly on hold.
Okay.
But it's starting to look like they're getting more open-minded to the possibility they might have to hike.
Okay.
And so we're trying to dimension out when that could happen.
So what's going to drive that? I mean, we've got, just looking at the bond market, we've got some real inflation fears out there, and we've got some real inflation data. People are talking about maybe $5 or $6 for a gallon of gas out there. How do you guys think about inflation?
Well, look, we think there are two ways that the Fed can end up hiking. One is there are good news hikes. The Fed cut rates last year to take out insurance against a fear that tariffs could cause a recession.
Okay.
That hasn't happened. So that's kind of like 98. Remember LTCM? The Fed cut 3 times after LTCM.
Yep.
They were worried that would be a recession. It didn't happen. The economy did really well. And then in 99, they took those cuts back. That's one way we could get there. Sort of good news hikes. The second is more of a negative story, which is that inflation is getting stuck in the economy. It's becoming a problem, and the Fed needs to hike to make monetary policy tight, so the economy slows down and inflation comes back down. And that's becoming part of the dialogue. That inflation has been too high for coming up on 6 years. It could be this way if nothing changes for several more years. It looks like the oil prices are going to seep into inflation on another series as well. And so both of these things could drive hikes, and they're both in the conversation at this point.
Given that backdrop, you can't keep the U.S. consumer down. I mean, the consumer's still out there. You talk about K-shapes or what, I don't know, but I just see some pretty good data out there.
Look, it's hard to not like the consumer given how much stimulus is going on. Wealth effects are driving things. Optimism about the future is driving things. The labor market has proven a lot more resilient than a lot of people gave it credit for. And so the consumer they tell you they're unhappy. They don't like inflation. They really don't like inflation. But they're feeling okay about things otherwise, and so they're spending.
Right. James Egelhof with this BNP Paribas. Thrilled to be with us today here to sign NVIDIA earnings and all that this afternoon. I got to ask you this. You came out, I remember when this happened. Robert Constable was high above Cayuga's waters, and he said, we need to do computer science. And Cornell led the way on engineering and computer science. Now, economists have this massive physics envy of mathematics. You actually did it. What do we miss in our analysis of what AI will do to our core GDP equation? What is this computer science revolution, which you have 2 degrees in?
Yeah.
What's it mean for the gross GDP of the country?
Well, look, I did my 4 years upstate, as you mentioned, so I a man after my own heart here, talking about Cayuga's
Did
waters.
you go to the Rongovian embassy in Tunkhannock?
That I did not do.
There's a massive deadhead. Jerome Powell went there.
I know.
All right, next time I go up for an alumni event, I'll make a note of that. So I think when we think about AI and the economy, it comes in 2 phases, where the initial phase here is about expectations. So people look ahead, they see the gains that are going to come, but they're not here yet. But they feel wealthier, they feel more optimistic. So consumers spend against their newfound wealth, businesses invest to be ready. And so right now we're in a demand-fueled part of the AI boom, where you could actually, we talked about being worried about the labor market could actually heat up because people are spending, they're investing to get ready for this future boom. There will be disinflation later once businesses figure out how to use AI and actually scale it into their operations, but that might take some time. For now, we think this is about demand. So that means strong growth, some strong labor market, and some perky inflation.
Bottle it, folks. What you just heard there is the single most succinct thing I have heard on the 2-part AI revolution. That was absolute. We'll try to get that out on single best idea if the interns are awake today. We'll have to see. Paul Sweeney with James Egelhof.
James, as we think about the AI, I think what amazes most people is just the total dollars that are being invested into this thing. I mean, we're seeing gajillions of dollars, tens, hundreds of billions of dollars. The CapEx numbers just keep blowing everybody away. They're coming to the bond market, financing all this stuff in the bond market. If you peel all that back, how's the rest of the economy, do you think?
So it's doing all right. And so ultimately, yeah, so we see AI CapEx is really strong. We think
Yep.
it's going to grow year on year this year, which is amazing given how
Yeah.
strong it was
Yep.
last year. CapEx outside of AI has been pretty flat. That's reasonable. It's basically the economy is transferring its basically investment budget away from other things towards AI. I think one other thing that we're seeing here, though, is that the optimism around AI is lifting all boats. So probably we would be looking at a less favorable investment, your trajectory here if it wasn't for all of this optimism. We'd be talking a lot more about tariff uncertainty and all that stuff we left behind last year. So it is becoming a very AI-centric economy, but that's not historically unusual. Back in the 90s, it was a very
Yep.
internet-focused
Sure.
economy. In the 20s, it was a very electrification-focused economy. The railroads in the 1800s
Yeah,
were
that's
a
the
huge
model I
deal.
use. It's like a railroad model.
Yeah,
You know.
it's a lot of the same risks too. That where the economy is levered into the story of optimism. So if it faded, like if the market sold off, I think we'd be looking for the Fed to come in with some help.
Are you wearing a currency tie from years ago? That's
I
the
am.
coolest tie.
I got it from my grandfather. Who
Yeah,
passed a long
exactly.
time ago.
That's wonderful because I remember this tie.
Yeah, sure.
Are you looking at me like I'm a grandfather?
No, I'm looking at this now. So
This
again,
is like the coolest when the cool people had a currency tie.